that money goes directly to principal. And you don't even notice because, frankly, the money is going out every other week anyway.
Of course, right?
Right? And so at that point, like, you actually saved a ton of money just by doing that, right? Because then it pays off more quickly. And there's, in some cases, like a $500,000 mortgage. You paid off your mortgage like 2.5 years earlier just by doing that.
That's a pretty substantial hop down there, right?
Absolutely.
Yeah. Hello, everyone. Welcome to Bamboo Vancouver's Property Management and Investment Podcast. This is actually our second year. We started this in February of 2023, so you're my 2-year anniversary show or something there.
Wow, honored.
Yeah, right?
Thank you.
So we've got Jordan Kofsky of Kofsky Mortgages back on the show.
Hello.
Just to basically go over, there's been a lot of goings-ons in the mortgage world, so
tell me about it.
We're going to get you to unleash that, and we're probably going to touch in on a couple of the things going on with the tariffs and whatnot. I guess we have to mention tariffs for SEO, so tariffs.
Don't forget the tariffs.
Excellent.
So tariffs.
Yes. So a couple of questions for you just before we get into it, so people kind of know who you are.
For sure.
How long you been doing this? What got you into it? What brought Jordan to the mortgage world?
Oh, that's a great question. Okay, so I guess this is my officially my 6th year in the business.
Yeah.
So I've done a full cycle. I like to say, I did a full 5-year terms.
Yeah.
So now I finally get my own. Some people calling me again to be like, "Hey, let's get the ball rolling again," which is kind of nice.
Yep.
But I started, right when COVID hit, and that was a very strange experience to get started in.
Oh, I imagine.
And then, but when I started, the idea was, how did I get into it? God, that's a good question. A couple of things. One was actually I was selling print ads. I used to sell print ads, BC Business Magazine, a couple other things.
Okay.
And eventually I sold one to a mortgage broker, a very well-known mortgage broker, one of these guru type guys.
Yeah.
And he calls me and he goes, "What are you doing, Jordan?" I was like, "What do you mean?" He's like, "You should be doing real estate or mortgages or something." And I happened to say I've always really been interested in getting involved in real estate. And then he started talking about which one I would want to do.
Yeah.
And of course, frankly, being dyslexic. And so I found myself being I'm very I want things black or white. It's one or the other.
Yeah.
It either works or doesn't.
So numbers will do that for you.
And numbers does that. Mortgages, I like finance. I like helping people. I like the connection, and I like working with people over time.
Yeah.
So all of those things really kind of come together as a very good mortgage broker. So I find that just fits me so well like a glove. And I've always been somebody I don't like to take orders from people. So I wanted to make my own business. So again, it just landed for me perfectly.
Yeah, absolutely. And it's funny you talk about the relationship building, working with somebody, because that is a major shift. I know that realtors have that moniker of the suit with the pads and sell, used car salesman. That's not how you do business at all. And once you build your relationship, then things go a lot smoother. You know what I mean? So,
I think the good realtors are like that.
Yeah.
There's a lot of realtors, I'm sure you know this, is that they're very transaction. It's boom, conversation's done, sales over, beat it.
Oh, I would never say something about that, would I?
No, never. But I mean, it's so prevalent in our industry that happens. And, even yesterday, someone was like, "You guys are all used car salesmen,
Yeah.
And I was like, whoa. You just talked to me for the first time on the phone.
Right?
Let's try and figure out how I can help you before you start insulting me.
Yeah, right. Fair enough, right? So I guess, speaking of talking to people on the phone, what are the steps to getting a mortgage? Just as a high overview, obviously, we could do an entire show based on that. But as a high overview, essentially, what are they going to ask you for? How do we begin?
Yeah. So basically, my very first phone call with a client is during our discovery call, we go over goals and things like that. But essentially, the main thing we sort of highlight is what are the 5 main factors of home approval. So with those 5 main factors, it's basically okay, what do they look at? They look at, for number 1, it's going to be your income and employment.
Of course.
So what do you do? How long have you been doing it for? How do you get paid? That sort of thing. Are you salary, hourly, etc.
Yeah.
Then it's going to be, okay, what about your assets? So do you own 5 boats? Do you own 3 cars? Do you own 2 houses? That's kind of important to know. But on top of that, they're more interested as well as things like things like liquid assets. That would be your stocks, bonds, mutual funds, savings accounts, etc. And then in addition to that, that would be 2. 3 is going to be your liabilities. So that's things like, what's your credit score? How are you doing with paying off your debt? What kind of debts do you have? How much do you pay out per month, etc., etc.
Yeah.
Right?
I guess also with the owning of the car, do you own the car or you're leasing the car? Because I'm sure people get this mixed up sometimes.
All the time.
I have a car,
Right.
I actually don't own it yet.
Correct. Well, and then what happens is that, you're paying $500 a month for it. I'm like, well, that $500 a month for it actually takes away from how much you can afford for a mortgage because you're paying out for a loan. And then finally, number 4 is going to be your the down payment. So how much money do you have, frankly, and where is it currently? There's a very big difference between it being in Canada or a Canadian savings account and it being in Ukraine right now or Russia. Like, well, hey, that sounds interesting, So they want it in, of course, Canadian accounts it all being very clearly organized and clearly shown exactly where that money is. And then 5th is the property itself. That's where you guys come in and make sure that the property is up to par. Because if the property is, the roof is caving in or half the building's falling off, the lender's not going to be so keen on that. If there's a big leak, you see lots of those properties on Broadway and in Vancouver, in that area, or the leaky condo syndrome, like that kind of stuff really causes problems, and lenders don't want to lend on those properties. So it doesn't matter how great you are with the first 4. If the 5th one, the property's no good, not much I can do.
Plus, you don't want to buy a shitty property anyways.
Exactly. It's a nice guardrail.
Yeah, exactly.
Really, yeah.
So now, why use a mortgage broker instead of a bank? I've seen numerous clients that say, I'm just going to go talk to my bank. What's the difference? Why use you?
Yeah, well, that's a really great question. And ultimately, I even tell clients, all the time, have you seen your bank yet? And they're like, oh, not yet. I'm like, oh, go do that. May as well see what other options you have.
Of course.
But if I have access to the same branch or same bank, well, then I go, hey, look, I have access to that bank. Not to worry. You can go there if you'd like. Yeah. But I'll probably give you the same thing. And they're like, okay, great. But in addition to that, so with a mortgage broker, we have access to 50 plus lenders across the board, all kinds of different solutions and options and products that are available for clients, where it comes from things like if you're a typical A1 guy that owns his own business or, is a salaried employee, okay, you're going to go one way. But if somebody else is something a little bit different, well, then you're more unique. Well, again, mortgage broker helps you because as an expert in the industry and expert in mortgages, that's my thing. So talk to me, we'll find a solution and make things work. I like to get creative. I like to find solutions to make things work. I had a client just recently, they were declined by the bank and then they came talk to me and then we got it approved at a different bank. Just by explaining it a little bit differently. And they go, oh, we can do that? Of course. This is how we present it. And they go, oh, okay, that works and makes totally fine. The bank was totally okay with it. And they go, works perfectly. So it's about that. And then in addition to that, outside of just the transaction, you got a mortgage broker for 30 years, or at least the good ones, right? We talked about relationship building. I call my clients after 6 months. Hey, did everything go through okay? Even after the first month, hey, did the first payment go okay? Yeah. How's it after a year? Let's go through an annual review of your mortgage. Are you paying off your mortgage correctly? Do you have any questions? Do you want to know a little bit about, what other goals do you have? Have you thought about doing, is there a refinance coming along the line? We're not talking this year, but in a couple of years, are you planning on having kids? What about things like a home equity line of credit? Do you know about how all these things work? Yeah. And then you have that conversation every year. Then that conversation becomes more natural and you become more aware. And then I really love it when clients get really excited about learning about their prepayment options. Yeah. I love that because if there's an opportunity to beat your bank, do it. Yeah, absolutely. Do it. Right? The banks make money for a reason. And so when the banks make money, which is great, good for them, they never not win. They never not make money.
The other bank has never lost money.
Right. They don't. So if you can figure out a way to sort of take a little bit of that share for yourself, take it as a win. And what those prepayment options are there for.
Okay. Now, with using a mortgage broker, how do you get paid? It doesn't cost the user generally, but how do you get paid? Who's paying you?
Yeah. So the client, 99% of the time, will not pay the broker. How it works is the lender pays me directly. It's sort of like a finder's fee. The lender goes, hey, great, we love these great clients. Well done for bringing us these amazing clients. Here's your finder's fee. Okay. And then the finder's fee is XYZ dollars, depending on how large of a loan it is and what kind of term it is. Yeah. It has nothing to do with the rate. A lot of people think it is, but it doesn't. So that's sort of how they do it. Term, rate, amortization, or, that kind of thing.
Yeah.
Excuse me. I said rate there, not rate. So term, the loan amount, etc. And so with that in mind, I think it's important that you work with a mortgage broker because, again, we're not taking your money. The bank has already sort of baked in the cost already. So it doesn't hurt you in any way to have an expert working with you as your guide. Right. And so I think that is what makes it important. The very, very, very rare opportunity or case where you have to pay the mortgage broker is when you have to go into like what are called private mortgages.
Okay.
And then that's where it's things like the broker will set a fee and say, hey, you owe 1% or 2%, et cetera, of the loan to me because your loan is so unique and so specific and so difficult, frankly, that this is how it works.
Okay.
But it's so rare that happens. And your broker should tell the client very clearly, this is what's going to happen.
Yeah.
Because it's part of the process. I don't want anything at the last minute to be like, oh, hey, by the way, you owe me like $5,000. Like, what do you mean?
Yeah. People generally don't like surprises with money, right?
No, I've learned that.
Yeah, it's funny actually, because I was going to ask you, like, what is that 1%? When does that come up, right? So that's good doing, Jordan.
Thank you. Right. Anticipating people's needs is key for being a mortgage broker.
Ching. No, right. So there have been some rule changes lately, like the extended to 30 years. You can put less down on up to 1.5. Can you explain both of these rule changes? Just because people have been changing. I mean, even as you said, refinancing is coming up. There's new rules now. So.
Yeah, so if you're first-time home buyer, and you're buying a property and it's over $1 million, you're now able to buy a place for over $1 million for less than 20% down, which helps out quite a lot of people because, Lord, like, man, it's tough to get like a $200,000 plus down payment to buy anything. Like, man. And so in the city of Vancouver and any other very high-end, very expensive real estate, being able to do that really makes a big difference.
Yeah.
So I found some benefits for that, for sure. Clients are liking that. And, I have a client, for example, right now that he has, about a 140, but he's looking at buying a detached home. And he's like, can he do it? The numbers work, his income works and all that. And he's new to Canada, so it'll get organized. So not a problem, but just had some trouble getting the down payment. So good for him that he's now able to do that. So it works. Then you're able to stretch it out to 30-year amortization now instead of it just being 25 years, which of course gives you a lot of options now because all of a sudden your cash flow is now is easier to manage because the payments are now lower because your, say, $1 million mortgage is now no longer amortized over 25 years. It's now amortized over 30 years, which is a larger.
Yeah, so it brings down that monthly payment, brings it down. Now, is that 30-year available for everybody or just first-time buyers?
First-time home buyers in this case. But of course, if you have 20% down, et cetera, then of course, the 30-year amortization option is available.
Now, will that 30-year amortization also work for a refinance if you've brought it down? Because you're going to build equity, which we'll talk about later on in the show as well. But will that work out? So if you're refinancing having to get your mortgage, your 5-year term is up, are you able to extend to 30 as well?
Are you able to refinance it back out to 30?
Yeah.
So it depends, right? So it really kind of goes with what kind of equity you have and everything like that. Could you just do it? Well, no, they're going to want to do like a check on the appraisal. They're going to want to make sure your house is worth what they say it's worth, et cetera, et cetera. And can you do it? Like, there's nothing wrong with it, but it's going to be like go through the hoops to make sure that you can, to confirm that you can. I don't want to say just carte blanche that you can, but very good likelihood that you'll be able to do the process. I've had many clients that did 25-year amortizations, insured mortgages, and then all of a sudden they were like, "Hey, our property's worth, way more now. So let's stretch it back out to 30 years, bring our cash flow to make it a little bit easier for us, and then we pay it out a little bit easier now, and it makes the whole scenario much more comfortable for them." Yeah,
just because I have a client who they have a unit that they purchased at $500,000 and now it's worth roughly around $750,000. So that $250,000 in equity, right? So that's kind of wondering, would they be able to extend you because it's a rental property? So obviously lowering that down, cash flow, all good in the hood, right?
Absolutely. Yeah, cash flow is king when you're doing an investment property. So yes, so exactly that would be one of those scenarios where somebody would be keen on looking at can they stretch it back out to 30-year amortization? They just have to go through the hoops. It's going to be an appraisal application and send me your income documents and we'll see.
Yeah.
But it's very good likelihood. We do it all the time.
Yeah. Now, you actually touched in earlier about how to sort of take away from the bank a little bit. What are some of the ways of doing that? Bubble payment, I guess, and stuff like that. And is there a blanket statement for bubble payments, or different products offer different rules, or what's the score on saving that money on the interest and getting at your principal there?
Yeah, that's a great question. And I love this. This is like one of my favorite things. One of the biggest reasons why I got into the industry was to help people with this kind of stuff. And so lump sum payments, or bubble payments, you like to call them, or balloon payments, other people like to call them. Essentially, how it works is some lenders offer slightly different variations on the same sort of product. So some of them are like, hey, you can do 25% on the anniversary date of the mortgage. And you're like, well, that's good. 25% is nice. I like that. But odds are, how easy is that going to be to do?
Yeah.
So, but you can only make one-time payment once, only on that date. Mm-hmm. Well, why do they do that? Well, they're able to collect interest from you all year, and then the compounding interest consistently. They make quite a lot of money off you in that case. Yeah. But other lenders will go, okay, well, we may not be able to go to 25%, but we'll go to 20% or 15%. But you can make the payment multiple times throughout the year.
Okay.
So it'd be like, okay, well, 15% is going to be, say, $150,000. Mm-hmm. Okay, well, you can do, $10,000 here, $500 here, there, and then maybe, $20,000 later, and then $12, whatever you want. And then you can do that all the way throughout the year. And each time you do that, it goes directly to principal, which means it brings down the size of your mortgage, which makes compounding interest better. And then therefore you're saving money overall.
Yeah.
Okay. Which makes it's a better product, in my opinion. In that case.
Basically, if you have a little extra scratch that you can save on, maybe consider hitting your mortgage at least one extra payment a year, something like that would be substantial.
Well, I'm a big believer in that. I'm a big believer in, you do things like your prepayment options, like changing your monthly payments. You can change your monthly payments to bi-weekly payments. And then bi-weekly payments are, I do this, I make fun of this and have fun with this with a lot of clients. I'm like, okay, there are 52 weeks in a year. There's 52 divided by 2 is 26 payments. And then 26 divided by 2 is 13. That means there's 13 months worth of payments. That extra month, because of course there's 12 months, one extra month, that money goes directly to principal. And you don't even notice, because frankly, the money is going out every other week anyway.
Of course, right?
Right. And so at that point, like, you actually saved a ton of money just by doing that, right? Because then it pays off more quickly. And there's in some cases like a $500,000 mortgage. You paid off your mortgage like 2.5 years earlier just by doing that.
That's a pretty substantial hop down there, right?
Absolutely.
Yeah, and it's funny that you say about it automatically coming out, because that's one of the teachings from a book called The Automatic Millionaire.
Sure.
And the same sort of thing that they say, like, to pay yourself first, so take that off the top, and the money that you have never seen, you don't notice it, it's all of a sudden just building. So it's one way to get ahead is to make sure that it automatically come out so that you never see it, and that way you don't miss it.
Right. You're not really like losing your money. It's just like the money wasn't there.
Yeah, exactly. Right? So yeah, it's a good method to do it automatically, especially with online payments. I mean, you can just set the number and forget about it, right?
Absolutely.
It's funny with that. I use that example with a lot of our owners that are paying their strata fees.
Yep.
Because when I'm asking them, we're taking the listing, how much are your strata fees? I have no idea. They just automatically come out. I'm like, that's what I'm talking about.
Right.
So you don't miss that. You just, you know it needs to be paid. It automatically comes out, and you don't really complain about it because you've never noticed it was there.
You just know you have to pay it.
Yeah.
Right.
This is gone. Same with gas. You pay for gas. Let's say I looked at the gas prices. I know I'm going to buy it. Why complain?
Right. It's a shrug. Like, I'll be mad for a minute, and you're like, all right, well, I'm getting gas anyway.
Right.
It is what it is.
So now, you did touch on cash flow before. Investing in Greater Vancouver can be really challenging to get cash flow.
Well, yeah.
Are you able to help people who are investing elsewhere? Nova Scotia, New Brunswick, anywhere not BC, because obviously you're licensed for BC.
Yeah.
How does that look?
So the answer is yes. So I've helped clients like purchase property in Nova Scotia, and how it works is essentially is that lenders sort of go, hey, how do you know this person? Well, like, it's my brother. Yeah. Well, I'm able to help my brother buy a place. Like, that's no problem. I don't have access necessarily to all the exact same credit unions and smaller time lenders that are over there.
Yeah.
But all the national brands, of course, we would. And then those lenders have like different sort of characteristics and priorities to make sure that you're doing it all correctly. And, and push comes to shove, every mortgage broker knows other mortgage brokers in other provinces. So what happens is that you say, you'll work with me directly, but, we're co-brokering it with another broker just to kind of get it done. And, we all make sure we're all connected together to make sure it all goes the correct way. Yeah. So that's how, we sort of do that. Because the idea, of course, is that we're licensed only for British Columbia. Yeah. Right. So that's kind of the key. But are we able to help people look for properties in other places? Of course we are.
Okay. Yeah. I mean, it works the same way with the realtors. Obviously I'm licensed in BC. I don't know anything about Nova Scotia, so I'm going to call somebody Nova Scotia for sure.
Yeah, right? Exactly. I mean, same sort of thing. Like, I don't know exactly what every offer is. Yeah. So I would rather the client have the best possible product and best possible rate and best possible, everything for themselves. So we make sure that we get done the correct way possible with in a co-broker situation usually.
Okay. Now you're talking about the products. We talked about a variable rate and a fixed rate.
Sure.
Obviously, standard fixed rate is there. Variable would vary, hence the name, I guess, right?
Sure.
Are there different qualifications for both, though? Like, because they have two different numbers, right?
Right. In a way, yeah. So, they both are subject to the stress test, right? So in that situation, so if the variable rate has a higher rate or a lower rate based on the stress test is either, the qualifying rate or it's the contract rate plus 2%. Yeah. Right. Whichever is greater. So right now you're seeing everything being like the contract rate plus 2%. Yeah. So if the variable rate has a higher rate or a lower rate, then it depends accordingly. Okay. So that's essentially how that would work. But to qualify, the income and all those things all still need to line up correctly. Okay. Now there were scenarios, of course, when the COVID-19 was going crazy and all the rates were low and then when skyrocketed and all of that. When that happened, there were a lot of people that kind of got caught because they needed to qualify for their home because many of them bought them, of course, subject free, and it was all that.
Yeah, so madness back then.
Right. So what happened was we had a conversation being like, okay, so to qualify for your home, you need to do it as a variable rate mortgage because then you can qualify, right? The numbers work because fixed rates were higher at the time. But then they can switch from a variable rate to a fixed rate when they're ready and if they want to. Okay. Just so the client knows that, but they can qualify with it at the variable. And that's just sort of how the system sort of works.
Yeah, okay. And that being said, you can only lock in from variable to fixed. You can't go back the other way, right?
No, that's kind of the point. And then the other thing, just kind of quickly, is the variable rate. There's actually two kinds of variables, right? Yeah. Right? So there's the variable that is like when the Bank of Canada changes the rate, does the rate change as well? The answer is yes, your payments will change, right? Like your monthly payments, will go up or down depending on what the Bank of Canada rate is, what your variable rate is, etc. However, there's an adjustable rate mortgage that's a little bit different. So those are the two different kinds. There's variable and adjustable. And then the other side is that what happened is the payment stays fixed, but interest versus principal changes directly.
Okay. Now those ones are also referred to as a trigger one. There's a certain level. Is that how that works?
So you hit what's called a trigger point, which is extremely rare. But of course that got hit because COVID-19 was bananas. Yeah. And everything went haywire. Like literally I would call banks and be like, hey, when was the last time a trigger rate was like hit? They're like, I don't know, 25 years ago. So like, what are the odds? But lo and behold, things went nuts. And but what happens is that in those kinds of scenarios, if you're no longer paying your monthly payments are no longer covering even the interest. Yeah. Well, now you're getting into trouble, and then all of a sudden you can end up being upside down. And then by the time you get upside down, which is like, you're beyond 80% loan to value, the lender will go, hey, we need to get this right back in line. You are forced now to pay XYZ dollars to get yourself back in line. And that can be a challenge. I always recommend to people in those situations when that was going on, I called my clients to be like, hey, do you understand what's going on right now? Yeah. Does this all make sense? How are you feeling? What do you guys want to do? And many people chose to stick with it and kind of go through that. And then, but if they hit the trigger rate, then they'll be forced to change. But I always advised, hey, this is now a good time because you're saving money because, of course, your monthly payments would have gone up, but you're saving that money. I recommend you hang on to some of that and start making some lump sum payments in those situations.
Okay, get that knocked down.
To get it knocked down, because now you're able to pay down the principal directly instead of being forced to pay some towards interest and some towards principal.
Okay, that's a good tip for, again, getting that mortgage down, paying the bank less interest so that you get more, right?
Yeah, I mean, you get kind of the best of both worlds. You're not forced to make your monthly payments go up, so you keep your cash flow okay.
Yeah.
But when you start getting that, that Christmas money or that bonus or whichever it is, use that money, pay down your mortgage, and then you kind of withstand the trigger rate. You kind of push it back a little bit and avoid it a little bit better.
Okay. So now that being said, if the worst of the worst happens, what happens if you break your mortgage?
Yeah, so don't call me. No, I'm kidding. No. So break your mortgage. That's common enough. So much like as you described. So if you're trying to go from a fixed rate mortgage to a variable, well, you're breaking a mortgage. Yeah, that's the way it goes. So you got to make a penalty. Or if you're moving, and you can't port your mortgage. Port your mortgage meaning you can't take your mortgage with you, so to speak.
Okay.
You have to break your mortgage, or you want to refinance, you have to break your mortgage, things like that. If you're doing anything within the term and you're trying to change essentially the terms of the mortgage, right? Well, that's a break of the mortgage, which means you get dinged on a penalty. So there's different kinds of penalties. There's the 3 months interest penalty or the interest rate differential penalty.
Okay.
And then in our world, we call it the IRD penalty. And that penalty is usually much higher than the 3 months interest penalty. So you try to avoid it the best that you can. And usually the 3 months interest is a much lower penalty, which is what you want to get.
Now, is typically the 3 months interest penalty more common on a variable or a fixed, or where would you find, is that more common somewhere? And it's obviously something you'd look for when deciding what mortgage to get, right?
Yeah, absolutely. That's actually a great question. So people choose variables versus fixed based on those reasons. So a fixed rate, if you break your fixed, you have to do an interest rate differential penalty or a 3 months interest, whichever is greater.
Okay.
Right? And as I mentioned, the 3 months interest is usually lower.
Yeah.
Right? So, and when you have a variable rate and you want to break it, then you're able to do just 3 months interest. So that's usually a better option for people in that situation. Now, what happens though is that if you decided to have a variable and you want to switch to a fixed, right? Well, that's no penalty. There's no penalty to do that at the same institution. So if you go to the lender and say, hey, I want to switch from my variable rate to whatever the fixed rate is now, I want to do that, boom, done. But then, of course, you have to sign a new contract. And the contract says, if you break this, you have to do interest rate differential or 3 months interest, no matter
whichever is higher. Of course,
exactly, right? And so, because all of a sudden you're now in a fixed rate mortgage. So that's just how that one works. Very common. A lot of people doing it right now because interest rates are so variable. Things are going up and down. Like people are just like, kind of what's going on.
Yeah.
The Bank of Canada, the tariffs we're going to get into. With all of that happening, a lot of people are kind of going, hey, maybe this is the time to go variable because things seem to be cresting and coming down. But as I recommend to clients, you got to understand what that means and how you're doing it and make sure you're in contact with me, your mortgage broker. I'll make sure I'm in contact with you so you understand exactly what's going on.
Yeah, the lay of the land before you go and pull that trigger, may accidentally shoot yourself in the foot, right?
Absolutely. Absolutely. And I believe being strategic is important. Don't just go into it and be like, yeah, I'll save money. I'm like, well, know what you're doing while you're doing it, please.
Yeah, of course, because you got to sort of balance out, is the penalty worth it to get the lower rate? Which is kind of what I was going to ask you right now is, in your opinion, with the rates that seem to be dropping gradually now, do you think it's better for people to go with the fixed or the variable?
Oh, man. Putting me on the spot. So I'm going to cop out on this one a little bit. And I'm going to say, it depends on the client, really. Yeah. I've had a client recently that I was chatting with, and they are really, really, really high strung. You could totally tell, you're talking. And they're like, so do you think I should go variable? And I'm like, look, you're worried about $100 about your groceries. We were just chatting about this.
Yeah.
And I'm like, maybe fixed. So you know exactly what your payments are, you know exactly what's going on, and you feel more comfortable. You don't have to do a 5-year fix. Why don't you do a 3-year fix?
Yeah, okay.
You know what I mean? And sort of kind of balance it out that way. And she never thought of that as an option. She was like, no, variable, because it makes more sense and I can kind of watch this thing go. I'm like, well, if you're willing to do that, you're going to have to kind of suspend how you naturally are as a person, which is making sure that you really want everything to be perfectly lined up.
Yeah.
I'm more than happy to manage that with you. But the key is that they need to sort of understand that's what they're doing.
Yeah.
You know what I mean? It's not there's no perfect solution, no perfect right answer to that. At the same time, if you're someone that's more risk comfortable, well, yeah, variable makes sense right now because frankly, you can see sort of across the board that, and all the economists are saying that rates likely will be coming down.
Yeah.
At the same time, during COVID-19, they were saying, hey, rates are going to stay low for a long time. Well, we all know how that worked out for everybody.
Yeah, right?
Right.
So we do have a lot of landlords, obviously, that follow our show since we're a show about property management and real estate. What do you suggest is better for a landlord? Do you suggest going with a variable because they theoretically can sell the place if need be? Or do you suggest to go with a fixed because that way, as you mentioned, it's a static payment. It's not changing for 3, 5, whatever your term is. Which do you think is better for a landlord?
Ooh, good question. So I would say in this case, so I have a lot of clients that are investors, right?
Yeah.
So we have that right? Weird. And so we sort of have that conversation about how we're going to do that. And so, as we said, cash flow is king, right? Absolutely. So if you can get into, like, as we were talking about already, is that there's different kinds of variable rates, right? There's the variable rate, for example, which has the trigger, which means that your payment stays fixed, but the interest versus principal will change, right? So, well, frankly, if payments go up or down, frankly, you don't really care. You have the property, you're getting cash flow, you're able to pay it off. So just that might be the most viable solution for you as a person. Of course, it differs for each person, right?
Of course.
But in that situation, I usually am a believer in that one because your payment stays fixed. Look, if your amortization goes from, say, 28 years to 28 years and 6 months or 29 years, do you really care? Not really. Yeah. At least, generally not really. And if you're really worried about that, well, use that extra money that you gained and put it towards your mortgage and start paying things off more quickly as well. That is also an option. And then with the variable, and you clear it quickly because you're in trouble or whichever it is that is happening, or you decide that you want to move or you just don't want to hang on to that property or whichever it is, troublesome tenant, I don't know. You just decide to get rid of the property. Again, you're no longer under the gun of it being an interest rate differential penalty under the fixed. Yeah. So the variable rate in that scenario makes more sense.
Okay.
That's my opinion.
So sort of a based on what's going on at the time or what your plans are for longer term, I guess, is really what it comes down to, right?
Absolutely. It really depends. And, that's my thought on just basically very on a broad based scale. But every client is different. Every scenario is different. And it's best to really understand what you're doing. And that's what's key. Again, working with a mortgage broker will walk you through this process, or they should walk you through this process and let you understand exactly what you're doing. I tell my clients all the time, if you have a question, call me, text me, email me anytime.
Yeah, if you have what you're for, right?
Right? if you have a question again later, that's the same question from before. Call me, text me, email me. Yeah. It's your money. You need to understand what you're doing with your money. Yeah. This is yours. This is very clear. Make it so you're as comfortable can be. And that's what I'm here for. You can't call the bank at 8:00 at night. Call me. I'll talk to you. No problem. We'll chat it out and kind of organize it. And then, then we'll talk again at 9 a.m. if you want to talk about it again. That's fine. I totally get it. And we'll organize it that way. And I think that having somebody that's in your corner the whole time is huge.
Yeah. Except don't call around 8 because if the Canucks are playing, you probably won't get back to them for a few hours, right?
Well, it really depends on how they're playing.
Lately you'll answer no matter what.
Right.
You did talk about porting your mortgage.
Yeah.
And that. So what if someone's buying a place that's either worth more or less and they need to port their mortgage? I know they can mix the pricing and all that. How does that work? What's the formula there?
Right. Great question. So there's different lenders have different policies on how the port works. Okay. So some of them will let you port your mortgage and almost do a tier 1 and tier 2 sort of policy. It's not two different mortgages, not two different charges.
Yeah.
But it's on the same mortgage, but they'll go, okay, you have tier 1. The first one is say $300,000, but then your second one is $500,000. The $300,000 one has a 2-year term left at 2.5%. But then the new one is 4.5% for 5 years. Well, you can set it up that way. I would recommend talking to a mortgage broker while doing that to make sure that they line up as close as you can, because it kind of sucks to have to, renew a bunch of times. It's the whole process is a pain.
Yeah.
And at the same time, the bank kind of owns you because you can't bring one of them with you and break the other. So that sort of becomes that also becomes a bit of a thing.
Yeah.
So with that in mind, though, you have that, and then you have another one that they'll actually sort of blend it all together.
Okay.
Right. So then they'll go, okay, you need your $300,000 one at 2.5%, but then you have a $500,000 one at 4.5. They go, well, we'll blend that together, and then all of a sudden now you have $800,000 at X%.
Okay.
Right.
Yeah,
and then
so
they
sort of like balance it out when lower higher sort of
correct
average it, give or take.
They average it out based on like multiple things, which is like the rate, the term, the amount of new money, things like that, and they sort of make it all work. So if there's it's like a lot of people like to go, well, I'm coming from this 1.8% with $100,000 and I'm buying a place that has a $900,000 mortgage at 4%. Well, then therefore it should be, 1.8 and 4 and blend together. I'll get this number.
Okay.
And I'm like, no, that's not the answer. How it works is they'll look at it. So they'll weight more heavily on the new money, which is far larger with the rate. And then they're going to go, you're probably going to end up closer to the higher one than the lower one. It doesn't quite split in half.
Okay, that makes sense. Now, you did touch in before on a home equity line of credit. And I guess equity in itself, what is it? Because some people are unaware. And then how can it be used? Because, some people say, my place is worth $200,000, but you have 4 more years left in your mortgage. So you can't break the mortgage, obviously.
Yeah.
So can you tell our listeners how to set this up the best so that you can actually make your place work for you?
Yeah.
The other way around.
Yeah, great question. So let's say, okay, you're saying that the person has their mortgage and they're like, hey, this place has gone up in value. I'm still in a mortgage. I'd like to open something like a home equity line of credit. Mm-hmm. So a HELOC, what we call in our industry, a HELOC or home equity line of credit, is what they'll do is that they go, okay, your property is worth, $900,000. Mm-hmm. Okay, and you're able to take out based on your income and the equity and how the math all works out, you'll be able to take out $200,000 hypothetically for your home equity line of credit. So you have to go through the process of how the bank wants to do it. The institution has to be able to provide that product, which is a home equity line of credit, because some lenders don't do that. And then what they'll do is they'll go, okay, they go through it, and then now all of a sudden you're approved, you go through the process, and now you have an account that has $200,000 in it. And then you have to pay whatever the mortgage rate is on it. It's usually some sort of variable. And then it'll be like you make the payments accordingly as much as you take out of that. If you take out $0, well, then you owe zero money back. but you have access to, say, $200,000. Okay. And it's always recommended that you get access to those things while you're working and while you're earning money, because it's a great rainy day fund scenario.
Yeah, just in case.
Absolutely.
Crash your car or something, right?
Yeah, I mean, look, I've had clients that go, well, I don't really want to incur more debt, and so I don't want to do that. I'm like, well, but it's like a rainy day fund scenario. Yeah. And if you get sick or you stop working or something happens and then you need that money, well, if you're not working, they're going to go, well, how are you going to pay back this HELOC? And you go, well, I can't because I just lost my job. Well, then you ain't getting the money. Yeah,
it's kind of funny how you can't get credit if you can't pay it. Weird, right?
Right. Well, the bank is the only place in the world that says you go in, you go, hey, I need money. Well, do you have money? Well, no, that's why I'm in the bank. Right. And then if you go to like a restaurant, hey, do you have any food? No, that's why I'm in the restaurant. Well, can it give me food? No. Do you have money? Well, okay.
Yeah, exactly.
Right. It's kind of an odd scenario where it's the only institution I can think of that it literally asks you for the thing that you're asking for.
Yeah.
If you have money, then they'll give you money. If you don't have money, it's much harder to get money from the bank.
Yeah. Well, it's also like super funny. It's same like those interview questions they'll ask. Oh, why do you want to work here? Because I need a job. I need money.
Right. That's how it works.
So with the HELOC or home equity line of credit, is there a cost associated with getting that? Like, will that put you into a higher interest rate on that mortgage usually? And additionally, if you don't have a HELOC on your current mortgage, is there a cost? Can you get a HELOC on one that you've already started in case somebody, hadn't thought about that or wasn't explained to them?
Right. So what you're saying is, just to confirm your question to make sure, is that if somebody has a mortgage already, can they get a HELOC on it?
Yes.
And so, the answer is you can open a HELOC, of course. If the institution is provides that as a product, provides that as an option. You can open it later. No problem, because if you don't have equity, then what are you opening?
There's no point.
What are you doing? That's not a thing.
Yeah.
So, so there's that. Now, do they go through the process the same way? They see the appraisal, they see how much it's worth, and then they go, okay, can you afford it? Here's your income. Okay, then great. Here, based off our results, you get a home equity line of credit based on all of these things. It's $120,000. Great.
Okay.
Right. And what was the second part? What was the other part of that question, if you don't mind me asking?
Oh, you already answered it about whether you can get one if you've already started your mortgage. Oh, and the other one was as well, is there a cost, like if you're getting a mortgage that has a HELOC on it, because now you can incur more debt, will you end up with a higher rate, or will it stick around what you're already paying?
Well, so it's two different products. So one is a mortgage, one is a HELOC. Okay. So, maybe a lender might look at it and go, oh, you're doing both. All right, we might give you a bit of a break. Maybe. Maybe. But, other scenarios, it's just going to be like, no, they're two different products. So you have a mortgage and you have a HELOC. Simple as that.
Okay. Yeah, that's a good way just to use that equity to benefit, because obviously if your home is not helping you build, then it's not really an asset.
Very true. A lot of people look at that and go, you're, in a sense, if you're not building anything with your house, for example, so to speak, then it's just an expense.
Yeah, absolutely.
Right? Until you pay it all off, then it's an asset.
Yeah,
right.
Exactly. Right.
But if you're able to consistently, your equity is going up and your cash flow and all those things are all good, well, then it's an asset for sure.
Yeah, absolutely. So just when people are starting to get their mortgages, a couple simple, I guess, FAQ questions.
Sure.
Roughly pricing at our current rates, what would $100,000 in mortgage be monthly, give or take, rough and dirty?
Right.
I mean, obviously, we don't need it down to the penny here.
Yeah. Goodness. Yeah, lightning round. So, essentially, I'll look at it and go, okay, let's pretend, average rates right now, let's say 4.5%, roughly on a 30-year amortization. Okay. And then it's $100,000. You're probably looking at $500.
Around $500 per 100. So basically, if you're carrying $400,000 in mortgage, 500 times 4, $2,000. Right. I got you there. And then with that, when you obviously go get a pre-approval, which you guys can hold the same rate for a maximum of 3 months, right?
90 to 120 days.
Okay. When you're doing that, what are some pitfalls that people do after that? Like, is there anything that they absolutely should not do after they get their pre-approval? What are a couple of the ones that keep you up at night?
I'm having flashbacks right now. Oh no. Actually, I wrote a book for, and I did it with realtors, and it was a funny memes. And one of them ended up being after your pre-approval, and then all of a sudden you drive up with your new BMW, and I'm like, wait, what? What did you do? And they're like, well, I got a new BMW. I financed it. I'm like,
that just changed everything.
You just changed everything. You know what I mean? So it's pretty crazy when people do that. If you're financing something or you're getting even a new credit card, stuff like that, it can make some effects. So I usually say, hey, when you're getting a home, just leave everything as is. When it's all done, then you can start looking at maybe, looking at financing a car or whichever. You do you at that point. But the reality is that if you start changing the numbers based off your pre-approval, the pre-approval isn't fully done. There's no 100% guarantee. Yeah. It's basically saying, here's a snapshot of exactly where you are right now. But if everything changes in a month, well, then what are we doing? If you all of a sudden don't have a job anymore, well, what am I giving you a mortgage for? Well, I got pre-approved based on my old job. Great.
Yeah, it doesn't exist anymore.
You don't exist. Right? You don't work there anymore. Right?
So basically what you're saying is once you get your pre-approval, just stand still. Don't go doing anything crazy, right?
Yeah. And if you are doing something crazy, like changing jobs, let's have a chat about that. Because I have had that situation come up, and then we just sort of navigate it and make sure that everything's organized. And even I'll call the lender and talk to them and be like, hey, the client is thinking about doing this. What are your thoughts on that? But this is how we're going to structure it and make it make sense. And the lender goes, yeah, that makes sense. No problem.
So also with the pre-approvals, how does that work for people who are self-employed, for instance? They're not on salary, or they're on, say, like realtors, for instance, commission.
Yeah.
Could have a killer 2 months and then dead. So how does that work? Is there any tips for people who are either the boss or the entrepreneur or any of these people?
Yeah.
How does that work?
these are my favorite clients actually. Is so how it works actually is that let's say you have your own like corporate income, say, and a lot of people like to hold their corporate income in the corporation so they can pay less in tax.
Yeah.
So as a result, lenders have sort of have programs called BFS or business for self, entrepreneurial type clients fit very well with this. So what they'll do is they'll look at your personal income, but then they'll also be able to look at your company financials, etc.
Yeah.
And then say, hey, we realize that you're holding your money in your corporation. That's great, no problem. Based off this information, we're able to boost your income to XYZ dollars.
Okay.
And actually that works. So in the same way with a realtor, in much like the business owner, they usually look at what's called a 2-year average.
Okay. So that's basically look for your tax returns past couple of years, see how much you brought in actually, and then average it across. I got you.
Exactly. And then if there's some sort of like event happening, like COVID-19. So what happens in that situation is that, okay, at the very beginning of COVID-19, nobody was going outside. No one was buying anything, nothing. Right. Yeah. So lenders were going, okay, I want to see how much you've already brought in this year. And if you're on track to make what you made the last few years, okay, sure, we'll do it. But if all of a sudden, like you go, okay, I make $200,000 every year, and all of a sudden you've made, $5,000 in the first 5 months, they're going to go, hey, you're not making the same amount, so you're not going to be able to qualify for that same amount.
Okay, and that absolutely makes sense, right? I mean, math is math,
right? You're going to go, look, this doesn't work.
Yeah, perfect. Well, I think we got through most of all the information that our brains can hold on for right now. We'll have to get you on again for more.
Glad to be here. I loved it.
Perfect. So if someone's trying to get a hold of you to learn more and use you as a mortgage broker, how do they find you? What's the best way?
First of all, you're going to talk to Haze. Haze will hopefully refer me, right? No, but more importantly, check out my website, kofskymortgage.ca. You can look me up on Google. Look up Jordan Kofsky Mortgage Broker, or probably even just Jordan Kofsky.
Yep.
To do that, frankly, I don't Google myself that often anymore. So hopefully I'm come up quickly.
It makes you sad.
Right? It does. It does a little. And so that would be a good way to do it. I'm sure you'll have my information in the description where you'll be able to get my phone number, email address, et cetera, that way too. And I'm always available to chat. And I'm always interested in kind of sharing. And I have this cool new program that I like to do called Adopt a Mortgage, where even if I don't have your mortgage, like I didn't actually do your mortgage with you, give me a call and I will like go through your mortgage that you currently have, walk you through it, walk you through your prepayment options, see what works, what doesn't, and then just try to be like your guide anyway. Because as I said, if there's a way to help, sort of beat the bank, I want to be there to do that. I really am. So that's sort of my jam about it. So if you want me to quote adopt your mortgage, feel free to reach out to me. I'm happy to do that too.
Awesome. Well, it's a great product and service there that I didn't know about that. I'll get you to check out ours now too.
Yeah, exactly.
Awesome. Well, thank you very much. If you guys have been listening for this long, we really appreciate. My name's Haze. This has been Bamboo, Vancouver's property management and investment podcast.